Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Nelson Chu. How you doing today, Nelson?
I'm good. Thanks so much for having me.
Good, good. We're glad to have you in the show. We wanted to address this topic. It's a topic that's been on my mind for a while, and really just hunting around trying to find someone good to talk about it. So, Nelson, maybe you can tell us a little bit about your background.
Yeah, absolutely. So I started my career in finance, and given what we're about to talk about, probably makes sense that I did start there and I start my career there. Spent about 2.5 years at Merrill Lynch, Bank of America, and BlackRock. Didn't really touch anything related to fixed income, but here we are today. Left that to really do my own thing, start a consulting company, helping other founders build their companies from the ground up. And then from there, started Percent. And so Percent is very much firmly in what you were mentioning, which is probably one of the most interesting asset classes in the market today, which is private credit. I'm happy to dive into more about sort of what that asset class is, why investors are interested in it, both retail and institutional, and what our role is in this entire broader ecosystem that is growing very, very quickly.
So, why did you decide to get into the private credit field?
Yeah, especially given my lack of background in credit, I guess. So it's
Yeah.
definitely an open question. So back in 2017, 2018, we were kind of doing a lay of the land exercise here in terms of what was out there in the fintech universe that would be interested or interesting to start a company in. And we saw a lot of different alternative investment platforms out there, whether it's, investing in startup equity, whether it's investing in real estate, some credit opportunities, not really. But the interesting thing was that there was actually a pretty poor experience from our perspective for investors, which was that if you were to invest on these platforms, you would have to put about $25,000 at a minimum to kind of put it to work into a single deal. The duration was super long. They were like 3 to 4 year lockups. And the yield, if it was a yielding asset, was about the same no matter where you went, 9 to 16%, give or take, right? So we wanted to try and find an asset class that would be able to kind of bring a lot of that stuff down. Shorter duration, lower minimums, and relatively comparable yields. And private credit stood out in that instance. Now, to be fair, back in 2018, 2017, private credit was not on the tip of everyone's tongue. It was actually a very esoteric, strange asset class that most people didn't really touch. And so it's been interesting to see it evolve over time. I'd like to think we're a little prescient, but I think really we're just a little bit lucky in picking what we did. But that was the one that I think met the criteria that we wanted to go out with to give investors something truly unique in the space they didn't have access to before.
So maybe you can help define private credit because I think a lot of people may have heard the term, but maybe they don't really understand what it means.
For sure. The easiest thing to think about it is basically non-bank lending. So rewind back to the global financial crisis, 2007, 2008. There was pre-crisis, banks did a lot of lending to small businesses, to consumers, and the like. And the reality was, once the financial crisis happened, regulators came in and said, you know what, we're going to make it very expensive for you to do what you do. And so they really took a step back away from doing conventional lending as we understand it today. Now, having said that, the demand from the borrowers, whether it's a small business or a consumer, didn't go away, right? They still needed to find somebody to fulfill these obligations, these loans that they needed to get. So that's when non-bank lenders stepped up. But the difference between a non-bank lender and a bank lender is in the word non, right? So a bank has a balance sheet, has deposits they can use from or pull from to be able to extend these loans out, and they make it spread against the margin. Non-bank lenders don't have that. They don't have a deposit base, and so they have to raise money from somewhere else. And that somewhere else usually is the private credit market, where they can raise various different types of loan facilities to be able to finance the lending operations they do on a regular basis. So to kind of put it in a perspective here, I'm sure a lot of us have heard buy now, pay later. I'm sure a lot of us have heard of like SoFi or Affirm or any of those guys. They are now public companies, but when they were a lot smaller, they were firmly in the private credit space, and they had to raise capital from private credit markets to finance their loan operations.
So it's interesting. I mean, everything used to be bank lending, and now the private credit market sprung up after 2008 because banks have become a lot harder to borrow from, for sure. Um, but it kind of raises the question, like, why do you need banks anymore? I mean, if you have this much money interested in private credit, like, why do you even need banks? Banks aren't even doing their job. I mean, are they even lending anymore?
Well, banks do a lot more than just lending, for better or worse.
Of
And
course.
so I think the day-to-day financial operations of what a consumer or small business needs is still definitely going to revolve around the bank. Trust me, I think banks would still love to be doing lending if they could. That is for sure, even if the regulators made it very expensive for them to do so. And nowadays, you're seeing because private credit is eating the bank's lunch for business, the banks are trying to find ways to get back in. And so whether it's JP Morgan, Goldman Sachs, you name it, they're all in and around the hoop for private credit, trying to find ways to leverage other parts of their business, set up a joint venture to be able to basically get back into that type of space without using their official deposit sheet, balance sheet, and without violating any of the regulators' rules. When you have such a hot asset class like this, it's very, very unlikely that banks will just sit on the sidelines and basically get their business taken away. So they are coming back in more ways than one, just not in the conventional sense of what they used to do.
So when investors are interested in private credit, where is the interest mainly focused at the moment? Because private credit's a broad description. So
For sure.
where's most of that interest generated right now?
Yeah. There's two segments of private credit. One is called the asset-backed side, and one is called the corporate debt side, right? So corporate debt is pretty simple. You're essentially extending financing to a single borrower, and it's usually a company. They could be profitable, they could be not profitable. The risk depends on how much you're willing to take in that instance. The asset-backed side is usually more like those buy now, pay later firms, those student lenders like SoFi's and Affirms, where there are hundreds of thousands of loans in that portfolio, and you're buying a slice of the entire portfolio, right? And it's been essentially structured in a way to help protect against defaults, and you get some downside protection, things like that. So when it comes to where we are in the credit cycle today, extending a straight corporate loan on a smaller company at the very least is pretty risky in this market at the very least. The yields are going to be super high as a result, and that comes with the territory of added risk. So we are seeing a lot more demand in what's called the asset back side, where there are thousands of loans backing your investment essentially. And within asset backed, there's things like small business lending, consumer loans, factoring of invoices, litigation finance, the list goes on. We are seeing, I would say, consumer credit being a little bit tricky right now. Credit card default rates are spiking. I would say there's a lot of debt being carried by the consumer. The general adage is never bet against the consumer, but right now you're definitely seeing some strains in the system. But on the small business side, I would say it's still relatively healthy per se. You are still seeing people shopping, buying, things like that, and we are seeing performance still be okay in that instance. The safest thing has always been historically factoring of invoices, where basically there's an obligation to make a purchase of that whatever they're selling because the invoice and the purchase order has already been made. So that in of itself is a fairly safe investment as long as you can mitigate against fraud and all those things which people do. But the yields for that are much lower. So there's a lot of variation in the credit spectrum right now and the risk spectrum. And for us, even on the platform that we offer, the yields can be as low as 10, 11% and as high as 25%. It really comes down to how much risk you're willing to bear and what asset classes are interesting for you.
Yeah, I mean, it's interesting what you're saying. I mean, the credit cards. I mean, I have one card that's like 11%, and everyone's shocked that it's that low. But I have good credit, and I have a business card. It's like 30%. Like they're getting away with 30%, and I have good credit. Like I can't imagine what people with bad credit are paying. How is that not imploding right now with the credit card market?
You're seeing it right now. There's a lot of pressure on that space, right? And so there's a lot of write-offs too that are happening as a result of that. And that's on the credit card companies to be able to figure out how to protect themselves and also ultimately, I think, see what they want to do with these consumers. But yeah, a lot of strain on that segment of the market right now on consumers. It's a tricky market to play in, and we're seeing appetite from investors as well be a little bit more cautious around any type of kind of consumer type credit card type lending. It's just a very, very uncertain market, especially where we are in the credit cycle. What happens with the rates from here? Do we stay higher for longer for rates? Is inflation going to kick back up or stay elevated? Those are all open questions that have direct impacts on the consumer, and you're going to see what happens if this stays and persists at the way it is right now.
So I know in a lot of states, Massachusetts being one of them, because I'm from Massachusetts, they have loan sharking rules. So credit cards have found ways around that because they are the exception. But I couldn't go lend in Massachusetts for more than 20% a year, or I have to get approved by the AG or something like that. There's some crazy rule. But when you're in the private credit space, you're not subject, I believe, to the exemption. So how do people get around those rules in certain states?
So I'm not a regulator, so I'm not going to be able to talk specifically around how to get around rules. I would say there are usury laws in place just in general across the board for every single type of lending, essentially. I think the expectation here is that for us as a company, we don't do business with those types of lenders, right? Like that's just not a position that we want to be in, and I think morally, it's just not the right place to be. But the in many of these instances, I think there are ways, there are gray areas, I think, that I've seen where they don't actually consider it a loan. And I've kind of heard that before. Again, we don't try and do business with these types of companies. I think they tend to actually implode upon themselves because of the level of risk that they're taking. So it really isn't something that I think we have looked into that deeply. And even in this instance, like, beyond just America, like we look at places where we can actually make a real impact. For example, like Latin America, where again, comparable rates to the United States, but it provides a much better and much more material impact to the borrowers there, where you can actually provide them financing they would never be able to get from a bank themselves, because the banking system is either so small or just so limited in the countries that they're living in. So it's something that we've kind of been very focused on just to make sure that we do right by the people that are underlying the borrowers themselves here.
Yeah, no, I get that, and obviously you want to take advantage of people, but in a free market, the rate goes where the risk is, right? And they're charging me 30%, and I think that's obnoxious because the risk of me defaulting is very low. I have never had any issues with a credit card, and yet it's 30%. So, but if they're trying to manage the risk of defaulting on others, then, like I said, other people have to be having higher rates. But if I'm looking at let's say I'm getting a bank loan. They might charge me 8%, right, on a piece of real estate. But
Hmm.
if I'm doing a private mortgage, right, or a private note, it might be 15%, right? That's the nature of the market, right? There's more risk
Sure.
there, and
Yeah.
if I'm willing to pay for it, then I pay for it. But I guess my point so if you have so rates are higher now than they have been because
Hmm.
generally rates have gone up. But what if they keep going up? Like at some point, a lot of these private credit markets are going to run afoul of usury laws just by the nature of the markets themselves, not because it's right or wrong, just because that's the way markets work. So I assume that all of these have that kind of baked in, or is like how does that all work? Because as if I'm an individual trying to loan money to somebody, I may not be aware of those laws, and I may run afoul of that. So how should people be approaching that in the private credit space?
So the key thing to remember here is that these are not actually loans to companies in the private credit space, right? So when you don't classify it as a loan, then I think it changes sort of how you can extend financing to various different companies. So when investors are investing, this is through our platform specifically, but it applies to larger private credit lenders as well. They are extending, for us in this instance, participation interests, or the buying participate interests in these loan portfolios. So it's a very different thing than a loan, right? And we never call this a loan. It's actually just, again, financing, essentially. When it comes to the underlying borrower of the capital, who is, for example, a lender, those are going to be regulated lenders with lending licenses that do have to follow these rules and regulations. So this just comes down to your point around a free market. What is the cost of capital that the market is looking for based on the level of risk that they're seeing in the market today, whether it's consumer or small business? And then the lenders themselves have to stay in business, so they will have to make a spread against what the cost of capital looks like. So, for example, to put numbers to this, let's say it costs in this market today to raise money for your loan portfolio 15% for easy math, right? Then the borrower who of this capital, who is a lender, is going to have to extend that and make at least a couple percentage points off of that in order to actually make some money here. So that is sort of the free market in action, where to your question around what happens if rates stay elevated or they go even higher from here, it's going to be a quite a bit of pressure, I would say, on some of these borrowers who need to be able to make that spread, and that may ultimately get passed on to the underlying borrower who is a consumer or small business, because that is simply just what the market will bear. But there is a healthy tension going on between private credit lenders and banks as well. Like I mentioned earlier, banks are coming back, right? So they are trying to find ways to do this. And if that is the case, banks are almost always the cheapest source of capital because, again, they have a deposit balance sheet to be able to pull from. And if that's the case, you are going to see rates in general come down if they want to compete and stay competitive into these getting into these opportunities. So I do think that even though rates are elevated, even though that is going to be likely the case for a little bit, you are going to see some competitive tension between in the market of private credit specifically, and that will change the dynamic for what cost of capital looks like for these borrowers, which hopefully will get passed on to, again, the underlying small business and consumer who is borrowing this money from a lender.
So, do you work in the real estate market at all? Because obviously there's a lot going on in that space. But does that cross your path?
We rarely touch real estate. We've done it every once in a while. But I think, going back to when we started the company, there's no shortage of other platforms out there that offer real estate. So the reality is we want to kind of be a little bit more differentiated, and we provide, I would say, more conventional private credit opportunities because real estate is technically an asset class in of itself.
Okay, so now, mainly with the business space, do you work with small businesses? Because I know that I've talked to a bunch of them, and some of them have really struggled to find to get small business lending from a bank, and the banks are notoriously stingy around here. There's maybe one that does a good job, and the rest of them will pretty much just waste your time, and they don't really know what they're doing. They run it through, and the criteria is really strict, and they make you run around in circles, and then they say no. So how does a private credit space improve on that? And is it within reason that a small business can afford?
Yeah, so going back to the two types of asset classes within private credit, you have the asset-backed side and the corporate debt side, right? So if you're talking about a straight small business loan or small business financing, that is corporate debt. And so you're extending financing to a single company, a single small business. We don't do that much of that these days, just in general, based on, again, where we are in the risk cycle. So most of our stuff is on the asset-backed side, especially the newer offerings that are coming out. And asset backed, one of the asset classes or sub asset classes within asset backed is small business lending, but we are extending financing to a pool of small business loans, right? So there's going to be hundreds of thousands of small businesses comprising this loan portfolio. And we don't actually see and talk to the underlying small business. We only work with the actual lender themselves who is extending that financing to that small business. And we're providing the capital to the lender to be able to do that. So these lenders today, I can tell you that there is definitely a probably some of the largest pipelines they've ever seen in terms of deal flow and small businesses, to your point around needing capital, seeing that a lot. And I think our job is to basically try and make sure that the markets stay liquid enough to be able to provide the lenders the capital they need to be able to continue to operate in this space. But going back to, if we're looking at it in the risk cycle and the credit cycle and seeing some concerns around extending single loans to corporates, these SMB lenders are seeing the same thing, right? So they're being much more discerning about what they are going to do and who they're going to extend capital to, because the bar, I think, is higher than it's ever been before because of the risks associated with the space today and what they're seeing right now. And they have the opportunity to be very picky because the pipeline is so large. They can pick and choose the best loans they think are going to perform well.
So we've had somebody in the past talk about litigation financing, but not really factoring. So can you
Mhm.
kind of talk a little bit about that? Because I've always been interested in that. Like, tell us a little bit about factoring. How does that work, and what are the pros and cons to it?
Yeah, for sure. Factoring is one of the most interesting ones because it theoretically should have 100% like performance rate, right? Theoretically, at least. So think of this as like, let's say you are a boutique producer of granola or something like that, right? And then you get a purchase order from Whole Foods for about $1 million. Now, you having only ever done, let's say, I don't know, $250,000 worth of business in this year, will never be able to scale up with the money you need to finance and create the $1 million worth of goods that you can sell to Whole Foods, right? So what you do essentially is factor the purchase order that Whole Foods gave you of $1 million. Let's say it costs you $500,000 to produce it, 600K to produce it, and you'll be able to basically get a loan for that 600K, go through a usual process of manufacturing, production, distribution, all that stuff, and then shipment and delivery. And then it goes over to Whole Foods. And once they confirm that they have it, they bought it, the money comes back. And then essentially you pay your interest off, and then you net the spread of the 600K plus the interest you owe to the lender. And then below the $1 million, right? That is going to be all your profit to keep. So that's a standard factoring invoice. And so theoretically, if Whole Foods already made that purchase order, then they're good for the money, right? Like they don't extend anything they don't think they can actually fulfill. And so if that's the case, then that's why the performance generally is very good. Now, if you're thinking, okay, so like, that all sounds good, where does this go wrong? It can go wrong in the supply chain, right? Like if the production isn't exactly up to par, if Whole Foods doesn't rejects it because of whatever reason, those are all things you can build into the actual factoring agreement itself. But then outside of that, there is also potential fraud happening where people just make up invoices, right? And so there's a lot of work that needs to be done in these transactions to ensure that the underlying invoices are real and you're not getting hoodwinked by a potential borrower. So that's sort of where the risk comes in. But at a concept level, this should be an extremely well-performing loan itself for the companies.
Okay, interesting. Yeah, and it makes me, I mean, one question that kind of comes up, I mean, you gave the example of the Whole Foods and you gave a pretty wide spread of profit, but I would imagine if people are selling a Whole Foods, their profit is probably pretty skinny. So are the rates they charging, are they let's just say hypothetically they're charging 10%. Is that annualized? Is that a fixed amount, meaning like it's going to take a week or whatever to float the money? How do they structure that with factoring compared to other things?
Yeah, that's a good question. I would say SMB loans in a conventional sense are much longer duration. Factoring is much shorter, right? So these are going to be, I would say, within like 30 to 90 days is the duration of the loan itself, because at that point you can produce it, ship it, and then they can mark it as complete, and then the money comes back. So it's shorter, but the rate itself is going to be essentially for that period in that, like, it again depends on the lender, but in that 10% plus range, right? Like if not more. But so on an annualized basis, that is high. But the reality is, this granola producer would never have been able to even fulfill the purchase order without this financing, because they don't just have that money on hand to be able to do it. So the reality is, it is a spread against their profits, but it's something that they wouldn't have been able to even get without having somebody come in and finance it. But I would say that margins themselves can be fairly healthy in this space in terms of just straight cost of goods sold versus the actual MSRP, what Whole Foods is buying it from. It's whatever costs they have built in from OpEx that kind of eats into that margins. But it should be, all in all, a net positive for them, because they wouldn't have been able to fulfill it otherwise.
Well, I mean, you said it was 10% for the period, right? For the 30 to 90 days?
Yeah, again, depends on the lender. I'm not going to be, we're not in that space, right? So like
Right.
we don't actually lend money. But we've seen some people do 10, some people do 20, like it depends. So it really just depends on the lender themselves.
I mean, from what you said, that's actually the high end of the range. Like you're looking at 100, anywhere between whatever that is, 30 to 100% a year. I mean, that's a lot,
But it's against the margin of the actual product itself, right? So again,
right?
they would never have been able to make this product without any sort of financing. So the spread is there for them to be able to actually still turn a profit on this. But yeah, again, this is, to your point, on a free market. I'm not here to set the rates. It's really what these lenders are doing, and this is what the borrowers themselves are willing to take, because they know they can actually still make a profit on these transactions by fulfilling these purchase orders. These don't just, I think it doesn't come from, um, it comes from what the borrower is willing to take at the end of the day. And that's how the prices get set.
Yeah, no, agreed. I'm just surprised. You said it was on the lower risk end of the spectrum, and that seems like a high rate for lower risk paper. Although I have to say, I've never seen anyone looking for funding in the factoring space. The ones I've seen have always been like these private people or groups, and they never really expand. They just kind of do their thing. Is there a lot of opportunity there, or is it still kind of contained within a small grouping?
No, definitely a lot of opportunity. I mean, I think most of these direct to consumer brands all are looking for factoring, right? Because they can never scale up without somebody helping to factor their invoices, because they have all these purchase orders. They just like, if only I could fulfill them, right? So you are seeing a lot of that happening. And it's been, I would say, a market that has been pretty consistent just in terms of growth overall. But I would say even in the last few years, with venture capital money flowing in, there's been even more direct to consumer brands, which means that the factoring industry has grown as a result of all of that. So it's been a good time for companies in this direct to consumer space in terms of demand for their goods. And it's also been a good time to be a factoring lender because of the fact that there's so much growth in that area thanks to VC money that is poured in.
Yeah, interesting. Very cool. Um, all right, cool. So now, obviously, with rates being higher, I mean, I don't know if you have thoughts on where we are in the cycle and what happens if we have a recession or a downturn in the cycle, which, I'm not saying it'll be tomorrow, but at some point it'll happen, maybe, unless we live in fantasy land like we have been. Like, do you think, what do you think is going to happen in the private credit space if we start to have a recession?
Yeah, I mean, it's been interesting because we've been in this space for 6 years now at this point, right? And we've seen like a low interest rate environment, a COVID situation, a post-COVID environment, a post-Fed rate hike environment, and it's all been, I think, a test for us as to sort of how private credit evolves in each of these different times, right? And the interesting part is for us and what we've seen at the very least, private credit is a bit of like a floating rate type of a mechanism, essentially. So for the space that segment that we play in, it's usually around 8 to 12% above the risk-free rate, right? So people are expecting and wanting anywhere from 13 to, I would say, 17, 18% in terms of yield. That's their target, right? And that's what they think is the premium for private credit versus risk-free rate. When it was a zero interest rate environment, we were in like the 8 to 12% range. So like this is just very normal, right, in terms of where it's at. Um, I think that will persist, whether it's rates go up, rates go down. That kind of threshold or margin is always going to be there, and that's sort of where private credit is clearing. What will be interesting is to see what happens when the banks themselves start to do more in this space, right? And they are definitely coming back. That will change sort of what cost of capital looks like. I do remember what private credit was like in the risk-free environment or low rate environment. There was just so much capital flowing around and being thrown around, and the rates were getting lower and lower, almost like to bank levels, which is kind of crazy. But I think you are going to see sort of that competitive dynamic come back if the way we expect it to, if banks do what they say they're going to do. In a recessionary environment, liquidity is harder to come by, right? Just in general. And so private credit is a great option at that point. Deals get done faster. There's more certainty of execution. All these things are things that borrowers look for. And so I do think that it is a fairly uncorrelated and I wouldn't say recession resistant, but at least it has the ability to stand on its own two legs in the event that the market goes down. So we like the way where we're positioned. We like where the asset class is positioned, and it just comes down to sort of how and when this all happens. My guess is I don't believe that we're going to see elevated rates from here. Like, I think the next step is going to be down, right? Like a drop in interest rates. I thought it was very, very strangely optimistic for the market to think they were going to cut that much in 2024. It just, was a little bizarre based on all the information that we were seeing. But I do think that, 25 basis points, maybe 50 basis points at some point in Q4 is not unreasonable and not to be unexpected here, as long as inflation can be kept in check, which is a big open question right now, based upon sort of where prices are going. Consumers themselves, the things that consumers need to buy very often have gone up a lot in price. The things that consumers don't need to buy very often have not gone up a lot in price, in fact, have gone down. And so that in of itself means that even though the numbers may average out, the reality is the pinch on the consumer is definitely there. And that's going to be, a question that the Fed has to grapple with.
Yeah. Yeah, no, definitely. Cool. So, we're gonna wrap it up here in a few minutes, but what are some final thoughts? What are some areas you think that people should know about that maybe we haven't touched on today?
Yeah, I think it's been an interesting time to be an investor for sure. There's never been so many options for you to be able to invest into, whether it's, equities, bonds, that's the usual, but a ton of alternatives, right? You can invest in private credit for one, real estate, art, collectibles, you name it. And I think it's just really important at this point when you're an investor to be able to diversify across all these different things. Do I recommend that you put everything into private credit? Absolutely not. I think it's really just a additive or addition to your broader portfolio that gives you some uncorrelated recurring returns if it performs. So that's the way I look at it. But just be open-minded and just don't be so fixated on sort of what has been and what has worked for the last 30, 40 years, because the world is very different today. And I do think private credit is having its moment in the spotlight for sure, but it's also one that's within good reason because it has given investors an opportunity to get into things that they normally would never be able to get into, and it's performed quite well for them for these last few years. And I do expect to continue to perform well, given sort of where we are in the cycle and what is the demand looks like from the underlying borrowers who are not getting the lending and the financing they need from what used to be in existence. So do your own research. I think but it's a fantastic and fascinating asset class that we've had the privilege of being a part of for 6 years now at this point. And I'm hoping that, the next few years will be even better than the first few.
Great. Well, Nelson, I really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you?
Yeah, we're pretty easy to find. It's just percent.com. And so take a look at that. Everything it's free to sign up. You can take a look at all the offerings that we had, both current and historical, going all the way back to 2019. And I'm also pretty easy to reach. If you have any questions, happy to chat with you. I'm just Nelson at percent.com.
Awesome. Well, thanks again for joining us, Nelson.
Perfect. Thanks for having me. It's great chatting with you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Nelson. Really appreciate him coming to the show and sharing his wisdom with us. Now we're into the abbreviated panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how you doing today?
I'm doing great. Not to say that Phil is less than, but it's only Phil and I. It's holiday week. It's going up on Independence Day week, and so everyone else is on vacation. So good for them. Not so good for us, but it's good for all you listeners because you get to hear more of, well, hopefully more of Phil. You don't want to hear more of me, but more of Phil anyway. So Phil, what do you think of private credit?
It can have its place. Personally, when I'm investing for myself or for clients, I don't use it directly. I will use some firms that do that kind of thing. I'll invest in business development companies, some of the alternative asset managers, which I know do private credit, but I trust them to be able to pick that better than I can. And I also do it in that form because I'm doing it through the stock market as opposed to holding it directly where you have liquidity problems or potential liquidity problems where you have something that you can't get rid of when you need to. So if you're going to make an investment directly in private credit, you have to understand that your money could be tied up and you don't really know how long because they're going to have windows. You're usually going to be stuck to invest in it for a certain amount of time, and then you may have some windows that you can get out. So you have to be willing to deal with that and accept that if you're going to do it.
Yeah, I agree. I think, private credit is interesting. And those listeners who know me you've been listening to this long enough know that I love alternative asset classes. Primarily because if you think about portfolio management, and I'll give everybody kind of a primer here without getting too boring. But when portfolio management, the theory behind diversification is this. Most people look at diversification like, oh, I just have a bunch of different mutual funds, different asset classes, bonds, stocks, whatever. Oh, I'm diversified. The reality is you're probably not. You're somewhat diversified, but the whole theory around diversification was not to have a bunch of different assets. It was to have a bunch of different non-correlated assets. So if you're investing in real estate, it would be like having a property in Boston and a property in Los Angeles and a property in Minnesota and a property in Texas. And if you're trying to diversify against weather or things like that, that is a way to diversify your risk, right? Now, they're correlated in the sense they're all real estate, but they're not correlated for weather if that's what you're trying to do. Now, realistically, real estate is correlated, so it matters a lot less about the weather. I'm just using that example, but here's some examples. So when I started, many institutions were investing in stocks and bonds. That was a very, very, very common asset class for big institutions, pensions, endowments. And subsequently, in the early aughts and tens, a lot of these institutions started getting out of the public markets. They started having smaller equity portfolios, smaller bond portfolios, and I think many of them are less than 10% stock and bond, like in the public markets. Less than 10% means 90% in the private markets. Now, their timeline is forever. So, some of the challenges that individuals have, they don't have. So, for instance, I'm going to retire at some point. I may not. They may wheel me out of the office, but at some point I will retire. And at some point I'm going to start drawing on my money. Until then, I need to grow it. And if I have an IRA, I don't need to access that because I can't, right? I get penalized and all that. But when I'm retired, I'm going to need to access it. So I can't have it tied up. It needs to be more liquid. But a university, they can keep it illiquid for 100 years if they want, if there's a benefit to it. So there's a benefit to that illiquidity for private institutions. Now, what typically happens we did a study back in 2008 in that the public markets correlate during times of distress. So if you look at now, as of today's June 28th, the day after the presidential debate, which we won't discuss, but I'm mentioning it just so you know the timetable. I haven't even seen it yet, by the way, so I'm excited to get my popcorn and watch the train wreck. But anyway, so if you think about right now, the markets are normal-ish, right? They're normal enough where things are operating on a normal basis. Now, what could happen, because the end of the month is the end of today, and then Monday is a new month. You never know. Maybe there's a crash tomorrow, or the next week, or next year. If we have a crash, most likely everything's going to correlate. So if you look at 2008, you look at 2020, 2017, very distinct things happen. When you have a crash, things tend to correlate. So everything, 2008, virtually everything was down 58.5%, give or take a few percentage points. The only thing that wasn't was gold and cash. Well, how can that be? I was diversified. It's because diversification doesn't necessarily work. It works in theory, but in practice, it stopped working. In large part because of these large institutions. So if you think about it, let's say you're buying a stock. Let's say it's ABC stock, right? And I'm buying the stock, and we're competing against each other, right? We're driving the price up. But if a big institution comes in and puts in $100 million, it's going to drive the price way up, right? Now, let's say they already own 100 million in the stock, and we're looking to buy. Well, let's say a crash happens and this big institution tries to sell $100 million of that stock. It's going to drive the price way down. That has nothing to do with whether the company's doing a good job or not. The company might be, the whole country might be in an airplane and they're selling parachutes, and still, the company's going to go down the tubes. not because the stock is worth less from a revenue standpoint, but because somebody is selling a big position. So when you have a crash, everybody sells everything. And I call it contagion, where it starts in a small place and expands and expands until it hits everything. So everybody's just selling everything. So 2008, people were just dumping whatever they could. That's why everything was correlated. So when you have a crash, everything correlates. So diversification doesn't help. But in the private markets, you don't necessarily have that. In a sense, you do, but they don't price it that way, which is actually one of the arguments you can have against private investments, is that they don't price properly. So that's both good and bad. So if you look at correlations, correlations are really strong in the public markets, and they're very highly correlated for most assets. Not everything, but many assets, a lot more than used to be. You look back 50 years, it wasn't like this. It is now. Mostly because the big institutions correlate the assets. That was my conclusion. I did a paper on it. It's on my website if you want to access it. But it shows the correlation of asset classes during distress, largely because of large corporations. So that was the conclusion I came to. And whether it's right or wrong doesn't matter, but it fits the frame. So it's something you can follow. So the question is should you invest in private investments? Because private investments typically have lower correlation. Back in 2001, Timberland REITs were a negative 0.01% correlation to the S&P, which is as good as you can get. There was virtually no correlation to the S&P, which is what you want if you're investing in the S&P. You want things that are not correlated. But a few years later, they became correlated because everyone knew about it. They were talking about it, and all the institutions are in it. So now it's a correlated asset. Now you got to find something else. Next came managed futures. Now managed futures are correlated, right? So everything institutions touch start to correlate, and so you just have to be aware of that. When you get into the private markets, they're a hot ticket right now. Everyone wants to get into private credit. They want to get private markets. It's a big deal. So most likely those are going to correlate as well. So how do you look at private investments, Phil? Like when you're thinking about things for your portfolio, like what are you thinking on kind of like a macro basis for how to look at these things?
It's a good question. And I think a lot of times it depends on the environment. Like if we go back to the zero interest rate environment, like private credit had some advantages because you couldn't get much of a coupon. If you're buying bonds, interest rates were so low, you couldn't get very much. And there were opportunities through private credit to get some. Like I know I was at a conference recently. I know I just said it was going back a few years, but I was at a conference recently where they had a package of student loans that they put together. And it was, the theory was these were loans that could be defaulted. But the way that they were structured, they're kind of telling you, well, this is the return you're going to get. And if you have somebody that needs income, private credit is a way that you can get income, and you can usually get a little bit higher rate. And you mentioned a couple of things though that like make me hesitate, and one of them is pricing. And I know we're talking about credit, but I'm going to use private REITs instead for an example because it's easier to think about. You know, the price of our house, you can look it up on Zillow, and maybe Zillow gives you a different estimate every day. But really, the price of your house doesn't change that much. And even if it does, you don't really care, right? Unless you're at that moment in time where you're going to sell, the change in value of your house is irrelevant to you. When you buy private REITs, they put a bunch of real estate in there, and the value doesn't change very often, if at all. Like when we had 2008 and the housing market tumbled, a lot of these things, they didn't change the pricing of the assets that were in there until they were basically forced to. And then all of a sudden you have a big loss. So you sit there and you think, you get these statements all the time and say, you're okay, you're okay, you're okay. And then you're not. So that pricing is an issue for me. And like I said before, the fact that the liquidity is also an issue because they're private. So there's not that public market. If I own a stock, if I own an ETF, if I own a mutual fund, I can sell it whenever I want. And I just go on in the exchange and I place my order. If it's a stock or an ETF, it happens instantly. If it's a mutual fund, it's going to happen at the end of the day. But I can have my money right away. When it's private credit or any other type of private market investment, I can't do that. And I have a client that came to me, had a private investment. He wanted to sell it. First of all, we had to find somebody that was acceptable to the custodian for them to be able to sell it through. Then they had to go out and find somebody to buy it. And then they took a cut from it, which is going to be bigger than what you would pay if you're selling in a public market. So those things make me hesitate. I do know advisors that use them. I mean, I had breakfast this morning with a friend of mine that he uses it a lot. So he says he can structure a portfolio that gets a 9% return, and he has somebody that needs that income, and it works great for them. But now he has some concerns, and he's thinking about going back to that client saying, I got to liquidate some stuff because I'm worried with the current environment that we're in, that we're going to get into the situation where all of a sudden I can't sell that. And it might not be producing the income either. So you just have to know about those pluses and minuses. I want to go back to a couple other things. I know that wasn't the question you asked, but you're talking about diversification. A couple of things I like to think about, like we think I own 10 different mutual funds. I'm diversified. You ever put it into like an X-ray tool or something like that? Like I use the software that looks at the underlying holdings, and it'll tell me the overlap that I have in portfolios. And I own 10 different mutual funds. Well, guess what? The strategies of those mutual funds may be very similar, and they have a lot of things that they own that are the same. And you look at it, you've got exposure, you got 10 mutual funds, and 7 of them own the same stocks, really. So you're really not as diversified as you think, because you have to know what's underneath. And the other thing, we talk about the idea that you're supposed to have stocks and bonds because they're supposed to move in different directions. Doesn't always happen, as you were saying with some of those other asset classes, right? Look at 2022. Stocks and bonds both went down. There wasn't a place to hide in either one. They moved together. So correlation is supposed to mean when things are not correlated well, they don't move in the same direction. They don't move in sync. Positive correlation is 1, negative correlation is -1. That would be where they moved entirely opposite directions. We don't really have anything that's at those extremes, and the things that we used to think offset each other no longer do the same as they did in the past.
Well, you raise a good point, and I think the question that you should also be asking yourselves are, what is the correlation you're looking for, right? Are you looking for no correlation or inverse? Because no correlation is, in my opinion, is the best, because you have things that are operating independently. You're not going to get zero. It's really hard. I mean, Timberland REITs in 2001 were the closest thing to zero I could find, which basically means that the stock market crashes, Timberland REITs are just going to do their own thing. They're not even going to pay attention, right? And back when you didn't have this contagion effect that you have now, you could actually find stuff that was not correlated. But now you also have the inverse correlation, as Phil referred to, which is stocks and bonds. Stocks go up, bonds go down, bonds go up, stocks go down. That was a historical correlation. Doesn't always happen. Didn't happen in 2022. That's when everything went down, stocks and bonds. So if you had a 60-40 portfolio, which is very common, you lost a lot of money. And everything was down. There was no safe haven. So the normal correlations, stocks and bonds, didn't work. And so you might have expected to only lose 12%, and you end up losing like 35%. That's painful. And most people aren't familiar with that because it's been 50 years since stuff like that's happened. It rarely happens. And so when it happened, people freaked out. Oh my God, 60-40 doesn't work. Well, if you're expecting it to work when interest rates are zero, then that was your first problem. That was pretty obvious. If you were buying 0% 30-year bonds, then and you weren't aware that you could lose 50% of your money, well, that's your fault, not the model. That's why we're in cash. People are like, "Why are you so much in cash?" Because it's safer. Like, I'm sorry, there's safety in cash. It's not going to lose money, right? Because it's just cash. And if I'm getting 0% interest rates, then what am I really losing? I'm not really losing anything. If anything, it's less risky, which is counterintuitive if you look at history. But the point being is, if you're trying to accomplish something, because inverse correlation is not necessarily about, or let me rephrase this. Inverse correlation should cancel itself out, right? So technically, inverse correlation is not a good thing, because if you make 1%, you lose 1%. It's inverse correlation, you can make 0. Well, that's no good. I can't do that. But really, what the inverse correlation does is it smooths the ride. So if you invested in the S&P 500, you're going to have some volatile returns. Oh, it's up 5%, it's down 5%. People are going to freak out in their statements. Oh my God, it's up, it's down. Like, what's going on? And people turn into, like, casino addicts. And you can see this with crypto. Like, I have some clients with crypto. They're like, oh, it's up. Hey, we're having a good day. Tomorrow it's like, oh, what's going on? This day's terrible. I'm like, just relax. You don't even have a big position in it, It's small. Like, it shouldn't be that big of a deal. But the point being is, it's really hard for most people to handle a 100% stock portfolio. Most people can't handle that. So most portfolios are designed for the consumer in mind. A 60/40 is a smoother ride. Yes, you have a lower return, but you have lower volatility. And what most people complain about is not risk, it's volatility. Why is my portfolio down 10%? 10%, that's nothing. Like, you go back, a decade or two, and that was just like a normal day. That was like a normal drawdown. You do that like 2 or 3 times a year, it would draw down 10%. Now, it draws down 3%. People are freaking out and jumping out their windows. Oh my God, what's going on? Like 3%. That's like a day stock movement, it's not even a big deal. What I'm getting at is that the importance of this is perspective, right? It's not about returns. Volatility is about the ride. It's about the ride from point A to point B. Is it bumpy or is it smooth? People want a smooth ride. They don't like bumpy. But that's how the markets work. You take risk, you get reward. You don't take risk, you don't get as much reward. That's how normally things operate. But right now, people want a whole lot of risk and they want a whole lot of reward, no risk. That's not how it works. Just because it's working now, it doesn't mean it works that way. It just means that right now, that's the way things are working. So, things aren't going to be this quiet for long. We have an election coming up, which I think is going to be underwhelming from a craziness standpoint. And I'm not the corporate media, so I'm not here to tell you that you should go move to another country because a convicted felon is running against a guy who doesn't even know his own name. Like that to me, I mean, that's a really bad setup for an election. But the media thinks there's going to be a civil war. They think people are going to leave this country. Whatever. It's the media whipping you into a frenzy so you're fear. We've had both of these people for 4 years. I don't like either one of them, but you know what? We've had them, and so there shouldn't be any surprises. And that's apparent in Wall Street stock prices. No one else is afraid either because they're known quantity. Whether you like them or not, it's irrelevant. That they're a known quantity. We know what we're going to get, right? We know Biden's going to be the same as we've had the last 4 years. I don't really want to go to more wars, but we know what we're getting. Trump we had for 4 years, and there's a lot of anxiety and angst and bad language and people are freaking out and like whatever. Maybe we get 4 more years of that. I don't know, but I know it's not going to be the end of the world because that hasn't happened in 4 years. It's probably not going to happen in the next 4 years. Life's going to go on. We're going to be fine. And I think if you kind of look at it from that lens, say as bad as you think it'll be, take a step back and you realize it's actually not going to be that bad. It's just going to be somebody you don't like. And that's very different from the world ending or Hitler taking over, whatever the narrative is at the time. So, but point being is that if you're getting into the public markets, it's not going to be easy to find non-correlated or inversely correlated assets. Most assets correlate now. But in the private market, you can get that inverse correlation or non-correlation, but they're illiquid. So you're giving up something in exchange for something else. So the question is what are you willing to give up? Are you willing to tie your money up for 10, 20, 30, 40 years? If you are, there's some good investments out there. If you're not, then you probably shouldn't be looking at them. But everyone wants to own the shiny object. Private equity, venture capital, private credit. And I'm not saying any of those things are bad. Like, many of them are really, really good. But are you investing because it's a shiny object, or are you investing for a specific purpose? So I would advise every single one of you to invest with a purpose, not because it's cool and shiny and different and because it's something you can wave around the country club that you got in this thing and somebody else didn't. Focus on what it's doing for your portfolio and, how you can turn that into positive alpha so you can have a better retirement. So Phil, let's, in the interest of time, and so we can all get to our holiday, let's wrap it up here. And where can people find more about you?
Sure. Thanks, Kirk. I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our blog. Thanks for having me today, Kirk.
Yeah, thanks for coming on, Phil. Always appreciate your wit and wisdom. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.